All right, so you are welcome to today's class, right? And so this evening we are going to look at some aspects of technical analysis. As we all know that technical analysis is very wide. In case you don't know, technical analysis is really, really very wide. And so you can't learn technical analysis in a day. You can't even learn it in a week. So what we want to do is to learn the different tools of technical analysis so that we can then put them together, all right, to formulate or to build up trading strategies that can make us money in the market. All right, so that's why a class like this is very important because it's like a basics, okay, a foundation, which we all need to be part of it. All right. So in the previous class, that was it on that was last week, we introduced ourselves to the concept of trend analysis, right? We talked about trends, how we can identify trends. I will also talk about the fact that within a trend, we have impulses and corrections. Impulses are moves in the direction of the trend, and corrections are moves against the direction of the prevailing trend. And we also talk about a trend shift, or what we call a break of market structure, or a change of market structure, which means that what are the things we need to see for us to come to a kind of soft conclusion. Okay, I call it soft conclusion because nothing is really actually concluded in the market. So soft conclusion that the trend has changed and we're about to have a bigger correction. So please visit our YouTube channel and watch the video on trend analysis. It's going to really be it's really very important. I have to say that. So please check it. And so this evening we're going to look at some indicators. All right. But uh, before we go into these indicators, let me say that personally, I am not a fan of using just indicators to trade. All right. So if I'm going to use indicators, I want to use it from the context of the market, from the context of the market structure. Maybe we should remind ourselves again that when the market is trending downwards, you see it moving like this, like this. When it is trending downwards, it's going to be giving us lower lows and lower highs. The lows are going to get broken. Okay, we have another low here. Price breaks below it. And so that means that the trend is bearish and it continues to go bearish. Meanwhile, in a bearish trend, why the lows are getting broken easily, the highs are being held. They're really being untouched. And then we said in the trend analysis class that the first time, once we see price now break above the most recent high, it signals that this trend has almost ended or has ended, and we are going to see a bigger correction, okay, before the price now decides where it's going. All right. So the same thing when the price is trending up, you're going to see moving in higher highs and higher lows. The highs are going to be getting broken. All right. The highs will be getting broken while the lows will still be held by the market. Okay. This correction is not going to get here. This one is not going to get here. So the lows are still going to get held by the market, are still going to be really, really strong because the market is trending up. And so the lows here cannot give us support, support. Okay. So when you look at a chart, there are two major things you can see. It's either that market is trending or it's not trending. So it's very important that we know what I actually call the market environment. What kind of environment is the market? So as a technical trader, this is one of the questions you need to ask yourself. Is the market trending or is the market not trending? If the market is trending, it's either is going in an upward trend or is going in a downward trend. All right. But if it is not trending, that means it's going sideways. You're going to see it move like this, up, down, up, down, up, down, you won't really be able to say, okay, this is the clear direction the market is going. And I showed some examples last week, okay, of when the market is not trending. This is a non-trending market, or some people, or you can call it sideways market or range. So the market, you can say the market is sideways, or you can say it's in a range, or some people even say consolidation. So these are just, words, terms, and all that. Not really big deal. It's no big deal. So what you just need to know is that what is the market environment? Is the market trending, or it's in a non-trending environment? Now, when you're using the strategy to trade, you have to ask yourself, in what environment does my strategy works best? All right. If the strategy you are going to be using is a trend-based strategy, that means the strategy is going to be at its best when the market is trending. All right. The strategy is going to be at its best when the market is trending, because it is a trend-based strategy. All right. Now, when you are now using that same strategy to trade in an environment that is sideways, that is non-trending, then your winning rate is going to drop. You're going to have more losers. Okay, you're not going to have big wins. Why? Because your strategy focuses on the market trending, but the market is not trending. That means you are trading in the wrong market environment. So if you can know at every point in time what environment the market is and what environment your strategy works best with, then trust me, you are going to be very, very fine, no matter what strategy that you use. So I have to say that there's no really technical strategy that works, there's no one that works. I mean, there's nothing like it's only one strategy that works. Okay, that's what I wanted to say. There's not just one strategy that works. So we don't have any case like, okay, before you can trade, you need to learn this particular strategy. It's the only strategy that works. No, we have different strategies that work. Okay, now depends on your understanding of that strategy. Okay, the build up of that strategy, and of course, the best market environment that strategy works. Now, there are some strategies that are range-based strategy. They focus on the market moving within a range. Okay, they are focused on market reversion and stuffs like that. So that strategy is going to work best when the market is ranging, for a ranging market. But when the market is trending, the strategy will tend to lose you money. Okay, so it's very simple. So it's very simple and straightforward. Okay, so but personally, because if you're going to learn from me, all right, and I hope that you can actually trust me to lead you all the way, I have to tell you my philosophy of trading, because it is on this philosophy that I build all my trading strategies on. By the way, I have up to 4 trading strategies that I use to trade. It's from the very basic ones to the really, really somehow not basic ones. Okay. So, but all of these strategies are based on a philosophy. So that is what I want to quickly share with you before we go further. All right. Are you guys ready to hear? If you are ready to hear it, type 1. If you are ready to hear my philosophy, okay, of using technical analysis to trade. If you are ready to hear it, type 1, so that we know that yes, we are listening to me. That's the essence. It's not that I want to disturb you guys. So just to know that, okay, want to know how many people that are listening to me live. All right. Not just people that are logging, they're just there and they're not really listening. So that's why. Okay, so 3 people. I have Maximus, I have Salami Ayola, I have Thank God. So that's three people only. So that means the rest are not listening. Is that so? Okay, let me see if I'm going to get more yeses. So while I prepare. Okay, so I'm getting more yeses. Thank you, guys. Thank God. Imo, Achibong, Lucky, Utubo. All right. Okay. Thank you very much, guys. All right. So let's look at this trading philosophy that I so much adored and that I've used to build different trading strategies, okay, for myself and for my students. The first thing I always want to do is I want to trade in the direction of the trend. So most of my strategies, if not all, they are trend based. Okay, trend. So which means that I always want to look at a market that is trending and a market that is fast moving. All right. So if the market is in a consolidation, you won't see me there trading it. I would rather wait for the price break out of that range, whichever way, whether it's the upward ways or it's downward ways. I want to see the price break away, build up some really, really good momentum, and then I can then look for suitable places where I can join that trend. So I am a trend-based trader. I love following trends. I love trading markets. Okay, market that is quite that has some good momentum, some good speed. And I like riding the trend a lot. All right. I like riding the trend a lot. That's the first thing. Number 32 thing is I trade price patterns. I trade price patterns. All right. Now there are different patterns that we can see on the chart. Can call them chart patterns, you can call them wave patterns, you can call them price patterns. Okay, whichever way. So these are patterns that I'm going to teach us. All right. Especially in the intermediate, we're already done with all these things in the intermediate class. We learned up to like I think 8 different patterns that they can trade and how they can trade them. Okay, so when we talk about patterns, we are talking about first impulse patterns. Impulse, we said that impulse moves are moves in the direction of the trend. For example, if I have an upward trend that goes like this one is an impulse, this is an impulse, this is an impulse. All right, impulse, impulse, impulse. Why? Because they are in the direction of the trend, one, and two, because they are fast. They are really, really quick. They are much quicker than the corrections. So I have what I call impulse patterns or impulsive patterns. So these are patterns that I can find here, I can find here, or I can find here. All right. So I trade. There are 2 impulse patterns like that I trade. All right. Other patterns are what we call corrective patterns. All right. These corrective patterns, they are the ones that I want to see ending these corrections like this. I really take them more seriously than the impulse patterns, but because at the end of a correction, you see an impulse. At the end of a correction, you see an impulse. I always want to be a part of these impulses. That's my philosophy. I wait for price to determine where it's going to give me a trend. When it does that, I wait for a correction, which is going to happen. At the end of that correction, I trade the next impulse. I wait for correction. I don't trade the correction itself. Then I trade the next impulse. So that means if I'm going to trade these impulses, I have to study how these corrections are going to end. And so these corrections, more often than not, 80-90% of the time, they end in certain ways, with certain patterns that are recognizable, that are repetitive and that are tradable, such that once I see the end of these corrective patterns, I know what next I'm going to do. There are so many corrective patterns. There are diverse corrective patterns, but I only choose, I cherry pick the ones that I use. Okay, the one that I use, there are about 4 corrective patterns. All right, that I use. All right, so which now means that once I see an impulse, I can use the way I define my impulse moves. I can use them to know whether it is an impulse. Then I wait for correction. When I see a correction, I trade a corrective pattern, and then I buy the next impulse in this bullish trend. Wait for correction and buy the next impulse. All right. So, but majority of what I've said so far here, we're going to be taught in the intermediate class. All right. But for the beginners class, what we're going to do is we're going to use simple tools, because a lot of us might not really be able to understand these ones because we are still at the beginners level. So we're going to use simple tools now. We're trying to build a foundation. We're going to use these simple tools that can help us to do the job of these patterns. All right. We're going to use them. So we're going to learn those tools that can help us to identify to do the jobs of this corrective pattern. So that means if we don't even want to look at the patterns and all that, we can use these simple indicators to identify when corrections end. We can now trade the next impulse. When corrections end, we can trade the next impulse. And this is just how I like looking at the market. Okay, so it now depends. So when I see correction and I'm trading the next impulse, whether I apply indicator strategy, whether I apply chart patterns, whether I apply wherever, it's the same philosophy. Okay, I just have different tools to that I use to achieve, okay, to support my trading philosophy. Okay, so that's it, guys. I like trends and I trade patterns. All right. I just love trading, in the direction of the trend. And you might want to ask me why. Why do you like trading in the direction of the trend? The reason is that, number one, the market is kind of more predictable that way. I mean, at least from my own end. All right. When the market is trending, profits can be quickly made. When you're able to enter into a trade, you can hit your target quick enough. Why? Because the market is moving fast. All right, the market is moving fast. In the intermediate class, we took some trades. Was not last week when the dollar was really, really very buoyant, very positive. Took trades on gold, sold Australian dollar, US dollar, and sold New Zealand CHF, and all of them got to the target on that same day. Okay, the following day. So they are really, really very quick. Okay, so that's why I like trading the direction of the trend. And the strategy that we used to do that, you are going to learn it in this set. All right, you're going to learn it. So get ready. You're going to learn the strategy. So make sure you are ready now. Because you're getting it for free, don't take it with an unserious. Let's take it very, very seriously. Okay. So having said all of this, let's now look at the tools that we're going to use. Okay. So if you check those tools, if you understand those tools, then we can start building them together. It's just like when you're building a house, you have cement, you're gonna have blocks, you're gonna have all sort of things on ground already, right? You're gonna have water, you're gonna have the laborers, you're gonna have this, that, everything has to be on ground before you now start mixing them together, putting one over the other, and then you start building a structure and all those things. It's the same thing here. So we want to start learning, want to start putting together, okay, all those different tools that we're going to use. So we're going to learn each of them on its own, separately, individually. All right. And I really appreciate if you all pay very, very serious attention to this. All right. Okay. So let's look at the first tool. The first two, we've already talked about it, like I said, is trend analysis. You need to understand how the market trend builds up on whatever time frame, whether the 15-minute time frame, the 1 minute time frame, the 1 hour time frame, the 1 day time frame, the 1 week time. It's the same thing. So the market is fractal in nature. What you see on 1 minute are similar things you're going to see on 1 hour, on 1 day, daily time frame, and all that. So trend analysis is, it cuts across all the different time frames. So I want to urge you to go to a YouTube channel and watch the video on trend analysis very, very well. Okay, because this is the foundation of everything that we're going to be talking about. The other two we're going to use is the moving average indicator. We're going to be making use of the moving average. I'm going to show you how we're going to use it. But before, okay, we're going to learn how to use moving averages generally. Okay, before we now learn how we're going to use it as it applies to us. Number three, we're going to use of the momentum indicators, especially the RSI, or maybe even the stochastic, right? And then we're going to look at price momentum divergence. That's it. Okay. These are the things we want to use. These are the things we will need. All right. So trend analysis, moving average, momentum indicators, especially the RSI or the stochastic, and then the price momentum divergence. All right, these four. So, but since we've talked about trend analysis, we have videos on them. We've talked about them already, so we don't need to go back there. And okay, maybe I should just say a little bit more, especially for those who are just joining a class like this. Okay, so when we talk about trend, we have an uptrend, we have a downtrend. So when the market is not trending, we want to wait for when it's going to return to trend, because there's a lot of transition in the market. You see a market trending, it goes sideways, it starts trend before it starts trending again, then it goes sideways again, trends again, it goes sideways, it trends again. So it's always moving from sideways to trend, from trend to sideways, and all that. So for somebody like us now, we want to be trading just the trend. We want to trade here when the market is trending this way. But when it's going this way, we won't trade. We want to wait till it breaks. So once it breaks, to reestablish this trend, we want to start looking for trade again. Okay, in this direction. When it goes sideways again, like we are having here, what happened? We just look for other markets that are trending. And then what happened next? Once it moves from this correction or from this sideways move to trend, we start paying attention again. We start looking for buying opportunities there, sell opportunities there, buying opportunities there. Here, these are the moments where we wait. Okay, we have 10, 15, 20 instruments that we can look at. So if one is not producing what we want to say, we just look at the other ones. All right. We also have another one. Yeah, this is a bearish trend. So that's it, guys. So that's how that's how it goes. So now, when the market is, let's say the market is trending up, impulse correction, impulse correction, impulse correction, impulse. What you want to do is that you want to use whatever tools you can use to know when this correction has ended. Why? Because once this correction has ended, you have the opportunity to trade the next impulse. As you can see, impulses are much bigger than correction. Instead of you to bother yourself about selling this, it's better you watch, it's better you buy the impulse, instead of selling into the correction, it's better you buy into the impulse. So when the price is making correction again, that is when you start waiting. You wait and then use all the different tools to know when this correction has ended again, and then you buy. You wait for this correction to end, also you buy. So all these tools here, they are the things we are going to apply to knowing when these corrections are going to end. All right. But generally, this is what we want to see. Impulse correction, wait for correction, buy the impulse, wait for correction, buy the impulse, wait for correction, buy the impulse. All right. The same thing when the market is trending down. Impulse correction, impulse correction, impulse correction, impulse. You want to wait for the end of this correction and sell the next impulse. Want to wait for the end of this correction and sell the next impulse. Want to wait the this one and sell the impulse. That is just that's the way it goes. Okay. So that's the way we want to look at this. I mean, the strategy we are trying to build. All right. We've taught, like 2 or 3 sets this strategy, and a lot of them are really making good money from it. I see results. They send me their results. Okay, maybe before the end of the class, or maybe not today, or maybe next week, I'm going to show you some of those results. All right, so that you'd see that, okay, some people are really making money with this. All right, so that when you also start making money, you can send me your results too, so that I can use your results to encourage others too. Okay, you want to do just like that. Okay, so now let's now go to the moving average, which is the second tool that I want to use. Now, when we talk about the moving average is an indicator. An indicator is a how do we put it now? So indicators are representations on the chart, okay, that are measured using, or that are built using mathematical formulas that are applied to the chart. Now, when you use the different parameters, price level parameters, maybe open price, lowest price, high price, close price, and you now use them, I mean, candle by candle, all right, and you now use them to build formulas that can be used to analyze the market. And these formulas, is not that you are the one that will build them. These formulas are now crystallized into solid pictures that we can see on our chart, and we can read, okay, on our chart. We can apply them to be able to know what the price is doing, or what the price is most likely going to do next. That is how I can define indicators, okay, from my own way. Okay, I'm not really very good with English. All right. So perhaps I should have used a much better definition. Well, don't worry. I'm just going to show you a lot of examples. I'm a very practical person. So when I show you examples, you will understand even much better than any definition. All right. So what is now a moving average? Now, when you look at every price chart, this is a candle, right? You have the body of the candle, you have the upper wick, like for those of you who attended the candle class. For those of you who didn't attend that class, you might look like, what are we doing here? This is the upper wick, this is the lower wick. This is the highest price, this is the lowest price. This is if this is the bullish candle, this is the closing price, and this is the opening price. Okay, now for the moving average, we are only using one price. Okay, a lot of people use the closing price. So let's say this is a 1 hour candle. We're looking at the 1 hour candles, or let's say, okay, looking at the daily candle. Okay, because the period, when it comes to the moving average, we use the daily periods. So that means at the end of the day, at what price did this market close? So let's say on Monday, Let's say on Monday, it closed at 1.2250. On Tuesday, it closed at 1.2350. On Wednesday, it closed at 1.2285. On Thursday, it closed at 1.2335. I know, and so on. These are the closing prices. What the moving average does is that if, let's say, for example, let's talk about the average first. What does an average mean? Average means that you are adding together the items that are given to you. Let's say we are looking at the age of everybody in this class now. We now want to find the average age of all of us in this class. So what we need to do is just to collect the data. So with the data, we need the data. So once you get all the data, or that's, we can call it the items that we need for the average, you add them together because they are quantities. You add them together and you divide by their number. That's average, right? It's a bit simple mathematics. So like we now, in this class, let's say if we are like 20, you add all of our ages together and divide by 20. That's going to be our average age. So in this case, now we can actually say the average price also. So that means you're going to add all the average closing price. Okay, we're going to add the closing prices together and divide by the number of days. If it's a 3-day average, let's say Monday, Tuesday, and Wednesday, we'll add all of this together and divide by 3. That's going to be the average for Monday, Tuesday, and Wednesday. If you want to add Thursday, that means we add this and divide by 4, and so on and so forth. Now, when we now talk about moving average means that since the market is always adding new data every day, the market is not closed. So on Monday or even on Sunday, the market is going to be opened again. You have another price on there. That's for the next week, and it just goes on like that. So that means, the average that you're going to be finding is moving. Let's say, for example, you want to use the 5-day moving average, for example. What it means is that you want to find the average of the last 5 days divided by 5. Okay, average of the last 5 days divided by 5. So let's say these are the 5 days we are starting with 1, 2, 3, 4, 5. Okay, let's say the average is the 5-day moving average. When you add all of this together divided by 5, let's say it's 1.2285, for example. Now, when it now gets to Tuesday, what will happen? How do we find the 5-day moving average on Tuesday? What will happen is that the last one here will be removed. That means the first data will be removed and then it will be replaced by the last data. So that means we're going to use this, the one for Monday, and then the one for Tuesday, and divide by 5. So let's say on Wednesday, we want to find the 5-day moving average also. We're going to remove this one also, and then we're going to use 1, 2, 3, 4, 5, and the one for Wednesday. Let's say the one, you just continue like that. As the day comes by, you are removing the oldest data, you are replacing it with the newest data, and you are adding everything together, and you are dividing by the number of items, the number of days of the moving average you are trying to calculate. Now, this is done automatically. Don't worry, you're not going to do this by yourself. Okay, so that's what we call the moving average. So as you're now having this data, 1.2, let's say the next one, 1.2275, 1.2322, and so on and so forth, just like we are for your graph. This are what are price levels on the chart. You're going to have something like, let's say this is 1.2285. Let's say this is the level on the price. 1.2275 is smaller. The moving average is going to drop to 1.2275. 1.2382 is larger. The moving average is going to go up like this. Let's say the next moving average, it goes down, it goes up, and then you now see something like a line that will be following the price very closely. So that means if the price is going down, the moving average is going to be going down. If the price is going up, the moving average is going to be going up. Okay, because we are using updated price data to update our moving average. So that's why we call the moving average a trend indicator. All right. Moving average is a trend indicator, and that is how it is being calculated. Okay, we're going to look at example of a moving average. I'm going to show you how you can plot a moving average of your own before we now talk about different ways we can use, or we can use the moving average signal on the price chart. All right. Okay, let me still leave all these things here, but they're not really that coherent enough. Okay, so let's use another sheet. So what we're saying is that, yeah, moving average is a trend indicator. We have other trend indicators, not just the moving average, but we're going to talk just about the moving average. We have the moving averages. We have the Bollinger Band, BB. We have parabolic stop and reverse. We have all these things. All right. So, but the one we're going to talk about is moving average, because that's the one that applies to what we want to do. All right. So okay, so how do we now plot the moving average on our chart? That's what we want to do now. So I'm going to share my trading, my chart with us, my MetaTrader 4 with us. And let me know if you can see my MetaTrader 4. I'm going to delete all these ones, delete all these ones, delete all these ones, then delete this one as well. Now, this is a chart, a naked chart, right? Nothing is on it. By the way, if you can see my MetaTrader 4, please type 1 or type yes or type something. Let me know that you can see it. Okay. So to plot a moving average, all you need to do is to come here. This is where we have the list of indicator, or indicators list. All right. So we have the indicators list, or you can right click, and can we find indicators here? I don't think so. All right. Well, I think there's one other place you can find the indicators, right? Okay, yeah, you go to I think insert, then indicators, and then you see them here. So here you're going to see that we have categories of indicators. You have trend indicators, you have oscillators, we have volume indicators, you have Bill Williams, and the one that are being customized, or what we call custom indicators. All right. So moving average is a trend indicator, okay, because it follows the trend. Okay. If the trend is going down, the moving average is going to go down. If the trend is going up, the moving average is going to go up. Okay. And for obvious reason, which we've already explained when we were talking about how the moving average has been developed. So whether you want to get it from here, insert, indicators, trend, moving average, or you want to get it from the shortcut here, this one is just click here, the same thing, trend, moving average. So once you click on it, you're going to put in, so there's going to be a box, and then you have to put in some parameter. Now, the moving average is dependent on the period. The example that I gave to us when we're doing the explanation was for 5 days. We can have way more than that. You can have 30 days. That means moving average of the past 30 days, which has been updated as price goes on, as we get new data, as the new day closes. You can even have 200, 250, 300, 500 day moving average. So this parameters period here is the number of days. So let's say we want to choose 50 days moving average, and shift should be 0. Now we have moving average method, exponential, simple. I don't think we really have so much time to explain between these two. Okay, let me just, these are the two most used. Now, the difference between the simple and the exponential moving average in the way they are computed is that the simple average allocates similar weight to all the days that are being used. The closing prices of all the days, all the closing prices that are being used, all the daily closing prices that are being used, the simple moving average allocate the same weight to them, right? Let's say 1, 1, 1, 1 for each of them. Okay. But the exponential allocates bigger weight to periods that are fresher. Okay, to periods that are fresher, it allocates more weight. So instead of, let's say, 5-day moving average, the first data that was used, let's say it's one is the weight. The second day data is now going to be 1.1. For example, the third day data could now be 1.15. The next one could now be 1.2. It's just saying that the market, this one is just trying to say that, the market, respect more. I mean, the market take cognizance of the closer periods more than the farther periods. So that's just the difference between them in terms of definition. Okay, but in terms of their appearance, exponential moving average, this seems to be closer to the price than simple. All right. Which for obvious reason, you know the reason why, because there is more weight is being put on the freshest data, the freshest daily closes. All right. So that's just the, but personally, I like using exponential. All right. That's what I use most. Don't really use simple like that. But if you want to use simple too, it's fine. So apply to close. So that means the data that I want to use, is it for the closing price, the opening price, the high, the low, or all of this? So the closing price is good. And then you can choose the color. Blue is nice. You can choose whether you want, how thick you want the line to be. So let me use this one. Okay, that's the second level. And you can go to levels. What do you want to add? Really nothing much there. Visualization, do you want to sit on all the time frames? If you want to sit on all the time frames, you make sure this is checked. If you want to sit only on some time frame, on the specific time frames, you uncheck this and then you choose which of the time frames you want it to appear. For example, if I choose 15 minutes, that means I will only see it on the 15-minute time frame. If I go to the other time frames, I won't see it there. Okay, but let's just put it on the all time frames and then let's click OK. Now, this is what we have. All right. You see, that's what we have. That's the moving average there, 50 days. And as you can see, as price is going down, the moving average is also sloping down. Meanwhile, as price is now moving up, the moving average is also sloping up. And so that's why we are making use of the moving average. Since we want to trade in the direction of the trend, it's good that we make use of a trend indicator like moving average. So that's how the moving average looks like. You can plot more moving averages on the same chart. So let's say you want to add 100-day moving average, for example. So the same way, trend, moving average, you go to parameters, put 100 here, exponential close, then you use a different column. You know the reason for that, right? So that you'll be able to differentiate between these two. And then let's say we're using red. This 100, you see. One thing you're going to notice here is that the 50-day moving average is closer to the price than the 100. Okay, 50 days. So the smaller the time, the closer is going to be to the price. 50 days will be closer than 100 days. If I put 20 days now, it will be closer than 50 days. If I put 250 days now, it will be farther than these ones. It will be farther away from the price. Okay, so that is the moving average. So that's how you can plot the moving average on your chart. Now, the next thing we're going to do now is how do we use the moving average? Okay, we've talked about the definition. We've talked about, we've learned how we can plot it on our chart. The next is how do we use it? Now, I'm going to first give you all the different, after reading books, after attending classes and all stuff for over, for 15 years, you know, or more. It's been a really long time. I've been learning this thing. Okay, so I'm going to put together all the different, the different ways people have talked about the moving average in the past, so that we can then select which one is going to work for us or which one we're going to make use of among all these different functions or functionalities of the moving average. So what is the first thing we use the moving average? Let's go back to our board. So what are the uses of the moving average? Now, some people, moving average can be used as direct buy and sell signal when the price cross over the moving average. So when you say, this is even like the beginning. This is like what a lot of people understand. I mean, then, right, when we've not really had, people have not really, a lot of people have not really worked on moving average. So this is what a lot of people know, especially in this part of the world. They believe that once the moving average crosses the price, or the price cuts the moving average, it's an opportunity to buy and to sell. Okay, so that's the first use that a lot of them, a lot of people know. Okay, so let's go to the chart now and let's see how that works. Now, when the price cuts the moving average downwards, it's believed to be a selling opportunity. Okay, either a candle closes below it or a full candle is formed below it. Different people have their different different parameters. Okay, some say, okay, once a candle closes below, it's a crossover already, or they want to say a full candle below. So this one is for, this is the, if you are using a candle close, yeah. If you are using a candle breaking completely out of it, a candle formed completely below the moving average, this is here. So the first set of people will have sold here. The second set of people will have sold here. Okay, so that is it. And as you can see, price moved. Now that will have been a lot of profit there. And here also you have the break upwards, some profit there. You have the break downwards. Here there weren't really profit right here, okay, because this is the candle close here, and there wasn't really much more before price moved up. So that would have been a bad one, a win losing one. And there's another one here, price broke above here, and it's a very good one. Here, price broke above, but it's not a good one. Here, price closes below, a good one. We don't really if it's a candle close, this wouldn't really have worked. Okay, this wouldn't really have worked as well. Okay, so that's just to tell you that, well, it's not really perfect, but if you are able to get a trending market, so that's why it's I said at the beginning that whatever tool you want to use, you need to understand the best market environment, or the market environment that it works best with. Moving averages, they work best. The kind of signal the moving average gives work best when the market is trending. Okay, this euro yen now, for example, if you want to count the number of good trades and bad ones, let's say from here, this is the first one, good one. This one is small. All right, this one is a bad one. That's 1 1. This one is a bad one. That's 1 2. This one is a good one. 2 2. Good one. 2 3. Bad one here. 3 3. Maybe just good one. 4 3. 4 wins, 3 losses. Good one. 4 4. Sorry, 5 3. 5-4, just tiny profit. Yeah, maybe 6-4, 7-4, not really that much. 8-4, maybe 8-5, maybe 9-5. So you can see 9 wins, 5 losses. And the fact of those 5 losses, this one is inclusive, okay, because it's a very tiny profit. Okay, you can see now that when you use the moving average in a trending market, okay, the winning rate can be really, really very big. As you can also see, a break downwards. This one didn't work out. Break downwards, break here. So this one didn't work out because price decided to go sideways. You can see price decided to go sideways. So when you want to use the moving average indicators straight off like this, number one, make sure the market is trending. Number two, make sure you use it during market volatile hours. Okay. So during market volatile hours, so most especially the London and the New York session, or maybe the crossover of the London and the New York session. And what do we mean by that? The London session in Nigeria starts 8 a.m. and it ends by 4 p.m. Now, before it closes, the New York session is going to start by 2 p.m. and it ends by 10 p.m. These are the most volatile market session. This is London. This is New York. These are the most volatile market session. Now, because the moving average works best with a trending market and a fast moving market, it's always very good to use it when the market is trending well. Okay. And market trends well during volatile sessions like this. Okay. So 8 to 4, 2 to 10 for New York, London. And now there is a session overlap here, which means there is a particular time when the London and the New York are working at the same time. And that is between 2 p.m. and 4 p.m. During this time, the market volatility is usually big, 70, 80%, 90% of that, unless it's just a very dull day. Okay. So somebody wants to be using this kind of signal to trade, he has to trade during this session overlap, okay, or during high volatile market periods in the New York or in London session, okay, or during London, New York session overlap. Okay. So, but everyone is using this kind of signal when the market is not really moving fine. You're going to get a lot of false signal. You can see break here, false signals, break here, false, break here, false, break here, multiple false signals there. Okay. So that's one way of using this indicator. Okay. Another way of using it is, of course, the crossover of the indicator itself. So some people, instead of them to look at when price cuts the indicator and all that, okay, they tend to use different moving averages, like here, where we have the 50 and the 100-day moving averages, and then they want to trade the crossovers, like we have a crossover here, then they sell. There's a crossover here, they sell. There's a crossover here, the buy. All right. Now, the difference between this method and the other method is that this one waits longer. Okay, this one waits more. It waits more before it gives you signal. All right. It waits more before it gives you signal. That's one. The second thing is that it's before it waits, because it waits longer, it tends to be lagging. Okay, it tends to be much more lagging than the other one. Okay, now somebody that is trading this particular one, for example, this particular signal here by the moving average, the person will have sold here at this candle break. Okay, but the first person that is looking for moving average crossover probably will be selling here or here, because it is around here that we're going to have the moving average crossover. So while the first guy gets in earlier, the second guy gets later. So the first way of trading it, let's call it the first signal. The first signal is when the price breaks around it. The second signal is the crossover of the moving average itself. The first signal gets in earlier, while the second signal does not. All right. Meanwhile, when you look at it again, this one here, when you wait for crossover, when moving average crossover signals, they tend to reduce the number of false signals. For example, within here, when the market was not really that volatile, was not even volatile, was just sideways, the signal one will have given so many false trades. Give one here, one, give one here, two, give one here, three, give one here, four. That's 4 consecutive losses there. So 4 consecutive false signals. But if one had waited, if the person that is trading a moving average crossover, the moving average crossover themselves will have only had 2 trades, one here, maybe around here, which was not really good, and then the second one here. So he will have had 1 win, 1 loss in that case. But the other guy will have had just 1 win and several losses, like 4 losses. Okay, so that's just it. So that's how, when we started learning, then that's how we used to trade the moving average and all that. So I'm not saying the moving average is bad, but it all depends on how you use it. Okay, it's good, but I'm going to teach you the best way of using it by just looking at it from the context of the market structure. All right, where we're also going to use some other tools, okay, to back, so that we'll be able to get better trades that will give us better rewards compared to the kind of risk we are getting. Okay. So apart from the crossovers, which other ways can do people make use of the moving average? Number 2, they are used to determine the trend. All right. Moving averages are used also to determine the trend. I mean, it doesn't really give us a robust definition of the trend. The one that gives us the robust definition of the trend is the one we did on trend analysis. Go and watch that video very well. That's the one that gives us robust definition, explanation, of the trend. Okay, but if you want to watch, if you want to just see an abridged version of it, a quick overlook of what the trend is like and all that, you can use the moving average as well, especially the larger time moving averages, like the 100-day moving average, like the 200, the 250, the 300, and all those ones. Okay, so let's see how that works on the chart quickly before we look at the third way. So I'm back on the MetaTrader 4 now. All right, so I'm just going to, let me remove this one, and then I can edit this one to a bigger moving average. So this 100 anyways is big enough, but let's use 250, for example. You can see that. Now, when the market crosses below the 250 moving average, we can actually say that the market is trending downwards. And in that case, we can look for sell opportunities. So this one is like giving us a bigger picture of what the market is doing compared to the smaller time frame. Once the price breaks below, it means we are in a bearish trend. You can see this one broke a little bit above before price returned downwards again, and the bearish trend continues. A tiny break and price break downwards for the bearish trend to continue again. Here we saw a bullish trend established. After price broke above it, stayed on it long and long and long before it broke downward, give us this bearish trend. And this one gives us a minor bullish kind of force. Didn't really determine the trend despite the break, but price quickly returned downwards, and we can see the bearish trend continue again. And same thing here, price broke upward, and we have bullish trends and a little bit of downward breakaway here, but didn't really result into a bearish trend. Meanwhile, the bullish trend continues. Here we've been in the bearish trend as well, but we have occasional touches of the moving average, and we've seen a minor break here, okay, which means that if the price is going to behave like this again, if this is just a minor break, we're going to see it drop down, and then the bearish trend is going to continue. Or if it resumes upward, so that means we have now transited from a bearish trend to a bullish trend. That is one way. That's another way of using the moving average to read the market trend, okay, from a very, very, how will I put it, microscopic point of view. Is it microscopic now? Okay, microscopic, just like you're looking at something far, as if it's close, all right? So instead of us to do a complex trend analysis, you can just use the moving average to just look at what the market is doing, okay, at the moment, what kind of trend we have, in what direction the market is moving, okay? So that is it. Now, what other ways can we make use of the moving average? The other way is that the moving average can serve as support and resistance. We've talked about support and resistance, right? For those of you who are not in that class, what we said about support is now a support, let's start with the resistance. A resistance level is that level where a bullish trend or a bullish momentum pauses and then turn bearish. This is the resistance level. So price was going up and then it got to a particular point and just dropped down. If you know this point ahead of time, what would you do? You want to sell around here, right? If you know that there is a point that when the price gets there, traders will start selling. They were buying before and they quickly turn to selling. That's a resistance. All right. If you know this level ahead of time, you can actually use it. You can, once price gets it, you can start anticipating a selling opportunity, right? So the opposite is the case when price is coming down like this and it just got to a point and start pushing up. Now that is a support. Support is when a bearish run pauses and turns to a bullish run. All right. That is a support. A resistance. When you look at your chart, you're going to see different, so many of them. Okay. If you are able to know that this is a support level ahead of time, what would you do? When price gets there, you can start looking for buying opportunity, right? So a lot of traders like buying at the support level and sell at the resistance level. So what the Bible now say that the moving average can act as a support and a resistance level. Okay, so that means we can find opportunity when price get there. Okay, when these moving averages are acting as support and resistance level. And also, in this case also, we make use of the higher time frame, higher time moving averages like the 250. So let's still make use of the 250 that we have there. So let's see how that 250 moving average has been able to act as a support resistance. In fact, if you look at here, it acted as a support here. Price broke upwards to give us a bullish vibe, like I'm going to go up, and then makes a correction to the moving average. And then the moving average provided support there. So at this place, at this moving average, we saw a turnaround and then the price moved up. So that will have been a bullish opportunity for some people who like using the moving average as support and resistance. All right. Same case here. Price broke and the moving average acted as a what? As a resistance. And then price started moving downward again. The same thing here. Just a minor break, a fake break. This is what we call a fake break. A fake breakout. A fake break is when price broke sharply and quickly returned sharply again. That's a fake breakout. Okay, so this is a fake here. So we can also say that the 250 moving average acted as a level of what? Of resistance here. Maybe here it doesn't really act as it. Price is right breaking away from that. Okay, so let's look at some other examples. You can see how it acted as support here. Support, 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 support. Right? If you mark it support here, support in all these places. You can see how it acted as support right there. All right, all these levels. Look at how it acted, just a minor break. Okay, maybe even here, this one is even better. Resistance. It acted as a resistance in all these places. This one, look at how it give us some resistance here, resistance here. Okay, price broke resistance, broke downwards resistance, resistance. You know, also provided support here, very close. All right. We also have some support here for price move up. So, which means that once price breaks the moving average, okay, we can then wait for some correction into it. Okay, because if you in your mind, I believe now that you are putting all of these things together. Okay, because when we talk about trend the other time, we're looking at up, impulse, correction, and I said that we want to trade the impulses at the end of the corrections. So which means that this first move here could be the one that broke the moving average, this one. You get that? Now this correction here, we can use the moving average support and resistance model to help us recognize where these corrections could end. Okay, so us knowing where the correction could end goes a long way. Now, when you know where something could end, what will you do? It's just for you to wait for it there, right? Just, okay, this is where the correction could end. You just wait for it there, right? So you can say the way it was very close here. So that's why I said that we are using it from the context of the market structure. So you have another impulse here, right? All of this, consider the market correct to very close to it. Yeah. If you had used maybe like, let's say 200 moving average, it will have just been around there for price move up again. So this is the end of this correction. Yeah. Look at this one here. Another correction ended around the moving average and price pushed up, right? So another impulse made a correction to moving average. The correction ends, price push up. So these are the areas where you're going to be looking for buying opportunities, and all that. Okay. So it's really very possible to use all of this from the market structure perspective. Let's even say you want to use only the moving average. Okay. Just the moving average. And you want to apply the market structure with it. So you can then, let's now go to the smaller moving average. Let's say we want to use the 15 and the 30 moving average so that we can use the crossover signals there. All right. So in this case, now we want to use all the different functionalities of the moving average together as a whole. So let's go. Let's see. I'm going to add this. Let's say I want to use let's say let me see 2550 25. So it's 25, right? And I want to use, let me add 50 to it. 50. Let me use black for that. Now look at this now. So when the price is, once the price crosses above the moving average, we'll be looking for buying opportunities. Once we are able to see a touch, I mean, when price gets very, very close to the moving average, that's where we're going to anticipate the end of our correction. All right. And so once the correction ends, what happened? Wait for crossover to buy. So that's a buying signal there, right? Once the price crosses over, the moving average crosses over, you have the buy signal there. This one also, you have the buy signal here. And even here, when price broke below here, that's a selling, that's a bearish trend being established there. And then you just wait for correction back to the band. Then wait for price to cross over the moving average. That's a sell there. Here also, price make a correction to this place. Then you just wait for a break, price to break below the band, the moving average. As it breaks below, you sell another profitable trade there. Okay. Also here, you wait for price to get to the moving average, to correct to the moving average. price has corrected to the moving average, then wait for it to now cross below it. That's a sell opportunity there. And so on and so forth. Here, we wouldn't have sold here. Why? Because price has broken way, way, way above it. Okay. And then from here, we now see a bullish, price has now transited into a bullish trend and a minor crossover here, you buy. So what we're trying to say in essence here is that the bigger moving average can help us determine the direction of our trade, while the smaller moving averages can help us, okay, to the trade signals itself. Okay, but that is not even what we want to do exactly. All right, I'm just trying to show you that, one of the best ways of using the moving average, combining all the different signals, all the different functionalities of the moving average, and crystallize it into a trading methodology. And you, of course, using the market trend analysis and structural analysis as a foundation, as the basis. Okay. Okay, but we even have tools that are going to give us much better stuff than this. All right. And if you are not in a hurry, I'm going to quickly show us in the next 15 minutes. So let's quickly look at the second tool, which is the momentum indicators. Okay, so these are the these are the three major use of the moving average. So let's now look at the momentum indicators. Now, momentum indicators, while the moving average and other trend indicators are always following the trend, okay, more often than not, they don't help us to identify where the market is going to drop. Let's say, let's say the price is moving like this, and it now gets to a point where it starts falling. While the market is going up like this, the moving averages are also going up. Now, when it now starts dropping, when it starts transiting from a bullish trend to a bearish trend, you're going to see the moving average do the same thing. Okay. Meanwhile, before the moving average moved that way, the price will have really, really gone down. So that's why we call the moving average and the trend indicator. That's why we call them lagging indicators. They kind of lag. They don't really help us know on time, okay, when there's going to be a shift in the market structure or a change of the market structure. So they lag in that regard, okay. The indicators that help us to do that much better are the momentum indicators. So the momentum indicators can give us quick signals as to when a top has been reached and price is dropping, when a bottom has been reached and price is going up, when a top has been reached and price is going down. All right, they help us to identify those levels quickly when a move is exhausted. Because when you look at a trend, you're going to see, because we said that, of course, we said a trend is made up of an impulse, correction, impulse, correction, impulse. We have all these joints, all this transition phase here, which are really very key. Transition phase, bullish to bearish, bearish to bullish, bullish to bearish, bearish to bullish. These are transition levels, okay? And the indicators that can help us to identify those levels best are the momentum indicators. The trend indicators cannot help us to do that because they are just following the market up and down. They're just following the price up and down. Okay, so they lag. But momentum indicators are called leading indicators. They tend to spot all those levels quick enough, okay, before we see a change, before we see the price start moving in the direction of that change, okay. And I have two very favorite indicators for that. I have the RSI and the stochastic oscillator. So we also call these indicators oscillators. When we say something is an oscillator is, from the basic knowledge of physics that I have, oscillator is something that is moving within a fixed range, that's moving up and down within a fixed range. okay, within a fixed range. So they go up, down, up, down. So at the top here, you have an upward range. At the bottom here, you have a downward range. A moment, please. So at the bottom there, you have this downward range. So which means that an oscillator is going to be moving. Okay. Um, uh, well, let me remove this one. Moment. Okay. All right. So which means that an oscillator moves within a range. You have an upper range, a fixed upper range. I mean, fixed boundaries. Okay, fixed boundaries, boundaries that are not elastic. Like they're just moving within a range, up, down, up, down, like that. That's what we call oscillator. They're just oscillating between two fixed ranges. Okay, for the market, it's the same thing for these oscillators. All right, for these oscillator indicate momentum indicators. So as price is moving up and down, they are also moving up and down. But while the price is breaking upwards, I mean, it does not really have any limit. It can go the way it likes. The oscillators are limited in the way they move. Okay, so you have the upper boundary. The upper boundary happens when, let's say, price is trending up and the oscillator is also going up. There's going to be a point when the oscillator is going to get to this upper boundary. At that point, the signal we're going to have there is that there is going to be some form of weakness. Now, we don't know how strong that weakness is going to be, whether it's going to be a tiny weakness or a deep weakness or a very deep weakness. We don't really know. But what we know is that once the RSI or once the oscillators, once they get to the upper boundary, it shows that the market is kind of overbought. Let's just use the term that is being used everywhere. So we can say that, okay, the market is kind of overbought. And when it's overbought, it means that we'll most likely start seeing some weakness. All right. The same thing when the market is going downwards, when it's trending downwards and trending downwards, you're going to see the oscillators also sloping downward. This is market is going downward like this. You're going to see the oscillators also sloping downward like this, and it's going to get to this boundary here. At that boundary, which we call the oversold boundary, the indication that we have there, all right, is that this selling pressure is going to get exhausted and price is going to start moving up. Okay, maybe a shallow move up, a deep move up, or a very deep move up. We don't really know at that point, but what we know is that there's going to be some kind of weakness. That's the information they give us, and they give it to us on time. On time. Okay, that's why we call them momentum indicators. They try to show us the market's momentum when that momentum is becoming exhausted and when we're about to see some reversal. Okay, so before the price reverses, this one will have given us the signal. Okay, but for the moving averages, before the price, before they start giving us the signal, the price will have moved. So that's why it's really very important to know the best way to use each tool so that you can then put them together in their best ways and then achieve something very, very good. All right. So overbought and oversold. Now, I told us earlier that these oscillators are between two fixed regions. So because if it's not within a fixed region, we will not be able to determine overbought or oversold. There has to be a level where we'll say, okay, this is overbought. There has to be a level where we say this is oversold, and they have to be fixed. All right. Otherwise, we won't be able to know. All right. So the highest point here is 100, while the lowest is 0. So that means it's moving from 0 to 100. But most of the time, it doesn't really get to the 100. Okay. So that's why we need to define our own upper boundary. Some people use between 70 and 100. Some people use between 75 and 100. Some people use between 80 and 100 for the overbought. 70 to 100. That means anything above 70 is overbought for them. So people that use 70 for overbought, they use 30 for oversold. So that means anything that is 30 or less is oversold, while anything that is 70 or higher is overbought. So the person that is using 75 is going to be 75.25. 75 or above overbought, 25 or below oversold. All right. Some use 80, 100, and 20 for their overbought and oversold. All right. Now, what are the numbers that I recommend? The numbers I recommend depend on what oscillator you're using, because these oscillators, they are faster than each other. Now, I have two very favorite among them, which are the RSI and the stochastic. The RSI is much slower than the stochastic, so I use 70-30. 70-30 reading. I'm going to show us how to do that. So which means from 70 upwards is overbought for the RSI, and 30 downwards is oversold for the RSI. But for the stochastic, which is quite faster, okay, the stochastic is faster, I use 80-20. Okay, 75-25 is good also, but I like using 80-20. Okay, so that means you need to go to 80 and above before I can consider it overbought, or 20 and below before I can consider it oversold. All right. So that is that about the fixed regions. So having said that, now let's now go to how we can plot this indicator before we now talk about how we can use it. All right. And then we'll now talk about the best ways of using it quickly. So let's go back to this place. I'm going to, okay, so this is where you get it. Indicators list, you click, and then you go to oscillators here, and then you can see the RSI, which means relative strength index, or you can see the stochastic oscillator here. So let's say I'm using the relative strength index. We're going to plot the two of them. So relative strength index, oscillators, they will appear here. They will appear in a separate um, um, chart away from the main price chart. You can see the moving average are plotted on the chart because they are trend indicators. They are following the price, while the momentum are kind of separate. You're going to see that. So you go to parameters, 14. 14 is good. Apply to close, choose whatever color you want. Fixed, you can see fixed, 0, fixed, under. Make sure these are checked up. By default, they will be checked. Then go to levels, and 30-70 is okay. All right. If you want to adjust, just double click here. If it's 20 you want, if it is 30 you want, just put it there. Okay, but 30 is good for me. Enter. If you want to do this one, you can double click. All right. So another thing I need to do, I also like putting the midpoint, which is 50. But really it's not really that needed now. All right. So I just not use it. So that's it. And okay, let me use red. Now this is it. Can you see this is it? So it's 70-30. Once the price gets here, as you can see, let's mark those places. When the price got here, when it reached 70 here, when the when the RSI reaches 70, what happened? Exactly at that point, the price started dropping. And look at how fast. Now, when did the moving average get the signal? here, around here, depending on what manner of signal, I mean, what type of signal, whether it's signal type 1 or signal type 2, like we explained earlier. All right. But this one will have helped us identify this early before the moving average. Right. So that's one signal there. We have another signal here. When the price crosses 30 here, because the price moved up. We have another signal here. Price moved up. At least just going to show some sign of weakness. Price move up when they touch 30, and then they touch 70 here. And price moved down. Then it touched 30 here. 30 and break downwards. Price move a little bit up before it moved down. And then the minor downward move that we are currently seeing, starting from here. We got a touch of a breakup of 70, which means that according to the signal now, we might start seeing this currency pair go down. Okay, so that's just how it works. All right, at least from the signal point of view. All right, so let's also put in the other indicator there. So oscillators, stochastic oscillator. So 10-3, I use 10-3-3 for this. By default, you will see 5-3-3, but I love using 10-3-3. And every other thing is unchanged. And for the levels, 80-20, you can see the 20 is already there. All right. And I just want to use blue. And okay. So this is what we have here. So once price, you can see almost the same thing. Can see? You can see? You can see? You can see all the signals that the RSI gave to us, Stochastic also gave to us. But there are some signals that Stochastic picked, the RSI didn't pick. Okay, based on the parameters. So I'm going to represent those one with red dotted lines. For this red one here, this one actually picked it, but this one didn't pick it. But it wasn't really that fantastic like that. This one also, this one picked it. You can see below 20. Okay, I think this one picked it as well. I think it picked it as well, right? This is around 70. So let me represent it with a blue line. Okay. And for this one here, this signal here, this, okay. Look at it. The RSI, the stochastic picked it, but the RSI didn't pick it. Didn't touch 70, but this one touched 80, which is just to show us that the stochastic is faster. When you use a stochastic, you're going to get more signals than the RSI. Okay, but the RSI is more accurate. Okay. Meanwhile, all the signals that the RSI will give you, stochastic will give you as well. But there are some signals the stochastic will give you, the RSI will not give you, because stochastic is much faster than the RSI. So if you want more trades, stochastic. If you want less trades with better precisions, RSI. Sorry, if you want more trades, stochastic. If you want less trade with better precision, stochastic, RSI rather. Okay. If you want less trade with better precision, that's the RSI. If you want more trades, stochastic. Okay, but you have to notice that if you are using stochastic, you are more liable to getting more wrong trades, okay, and more right trades. If you are using RSI, you are more likely to get less wrong trade and less right trades. All right. So it all depends on which one you want. But which one do I use? I use the RSI. I'm a guy that don't really like taking all signals that are available here and there. I can really be very, very selective when it comes to trading. Okay, you can see this one also. The stochastic gave us signal, RSI didn't. Yeah, stochastic gave us signals, RSI didn't, and so on and so forth. Okay, so that's just it. Our time is going very fast. Okay, so let's now look at how we can make use of this. Do we have to start trading all the signals, all the overbought, oversold, overbought, oversold? So if you look at it, you're going to see that we even if you look at it, you're going to see that yeah, there are still a lot of false trades that we'll have gotten if we just pick every overbought and every oversold. Okay, like this one here, wouldn't really have given us money. This one too wouldn't have given us money. You know, this one will have given us good money, good money, good money, good money, and so on like that. Okay, and what you're gonna notice is that it's very good. Okay, it's more profitable when we use this signal, this momentum signal, to identify end of corrections. Don't use them to identify end of impulse. End of impulse. This is an impulse. I'm going to give us that better. This is an impulse. After this impulse, the RSI and this one give us this oversold signal. Are we supposed to buy? No. Okay, you don't use this indicator at the end of an impulse. You use it at the end of a correction so that you can trade the next impulse. Now, although it gives us minor movement, but it's too small. We don't have really made anything really big from that. Remember, you want to trade the impulses. The impulses are the big move. These are the impulse, 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 impulse. These are the impulses that you want to trade. Not all these corrections here. You can see the way they are tiny, apart from this one. You can see the way they are tiny, right? Corrections are tiny. So you want to use these signals, these momentum signals, for end of corrections to trade the next impulse. So instead of me to use these signals, I want to trade this signal, but I'm going to trade this one because I'm having a correction here now. And at this point, this one was able to give me a signal and then sell. We can see the profit. I'll be able to get in early. My stop loss will be small, and then my profit will be big. Same thing here. Same thing here. We have another impulse and then a correction also. At that point, I also have a signal here from the stochastic, and then a sell opportunity came. Same thing here. We have this one here. You have end of correction, especially at this this bigger moving average. You can see the way the bigger moving average acted as a resistance here. It acted as a resistance here. And this one are also confirming that the correction has ended. And then I'm selling. All right. When this impulse got to this point, this one was here, oversold. Will I buy? No. Why? Because the market is trending downwards and I want to trade in the direction of the trends. I will only wait for a correction and sell. So that now brings us to these few points that I want you guys to take seriously as far as the momentum indicators are concerned. So in a bullish trend, use the oversold indicators. When the market is trending up, you use the oversold indicators. But in a bearish trend, okay, let me complete it. Ignore the overbought signals. Okay, I think it should be signal, not indicators. Right? In a bullish trend, use the overbought, oversold signals. Ignore the overbought signals. In a bearish trend, you use the oversold or trade the oversold signal, but ignore the okay, like this. In a bearish trend, right? Use the overbought signal, but ignore the oversold signal. So what I was saying, when the market is trending up, only trade at the end of the corrections. At the end of this correction here, you look for oversold. At the end of this correction here, you look for oversold so that you can trade the next impulse. But when the market is trending upwards, ignore the overbought signal, because the overbought signals, they happen at the end of an impulse and a correction is coming. And you don't know whether that correction is going to be shallow or it's going to be shallow. If it is a shallow correction, you won't make anything from it. You will most likely lose that trade. As you can see in the examples that we gave when we look at the chart. So this is not right. You don't look for overbought in a bullish trend. This is not right. You don't look for overbought signal in a bullish trend. This is not right as well. Okay. What is right? This is right. Look for oversold is right. Likewise, in a downward trend, oh, in a downward trend, you are going to ignore the oversold signal, because what do? They signal the end of an impulse. You don't trade the end of an impulse, you trade the end of corrections to take the next impulse. Remember, you are trading the direction of the trend. You are trading the direction of the trend. So this is where you wait for the end of correction and trade. End of correction and trade, not the end of impulse. All these ones are wrong. What do? You only trade overbought. You use overbought signals, overbought signal, and then you trade the next impulse. So these ones are right. I hope that makes sense to you. If this makes sense to you, just type 1 if it makes sense to you. So let's now look at some examples. We've almost come to the end of the class. So let's now look at some examples quickly in the next 5 minutes. But if this makes sense to you, please drop a message. Just type yes or 1 or something. Let me know if it makes sense to you. So we're even going to let's look at euro dollar, for example. All right. And I'm going to remove all these indicators. I'm just going to use these ones. So we have the RSI here. I might also use the stochastic as well. 80-20. All right. So all right, 80-20, right? So let's look at it. Let's just start from somewhere. I want to look at a proper trend. Okay, let's start from here. So you have an impulse, a correction. Okay. Okay, let's start from here. You have an impulse here, a correction, but we didn't really get any signal here, right? And price continued to go up. But we have a signal. When the price is going up, what do? You buy the oversold. Now, this one gave us oversold here, right? And what happened? Price moved up. You can just plot your trend line like this and wait for trend line to break, and then you buy. Or maybe you can even put your moving average, use your moving average crossover as an entry signal. All right. But I love using this trend line here. So price has been trending up. You make a correction, and because it's trending upwards, I want to buy the oversold. The oversold happens here. I plot my trend line. I buy after the trend line break, and I make money. Where do we have the next oversold? Remember, I'll be ignoring the overbought. When do I have the next one? I have the next one here. This oversold here. The RSI is not giving us anything because these corrections are very tiny. And I put my trend line again. It breaks upward. I buy again. I make money. You can see 2 consecutive winners. When do we have the next oversold? Yeah. What do I do? I plot trend line again. Price break above it. I buy. I make money. What again? Another one here. Oversold on the stochastic. Stochastic is very fast. I plot my trend line. It breaks it. I buy. Profit. The next one here. I plot my trend line. We don't have any break. I don't trade. No trade. Yeah, because there was no break. Okay, I have the next one here. Then I plot my trend line. We also learn how to plot trend line, right? That's why I said that, all these things, everything that we learn, we are going to make use of it. Okay, so the way we structure our training is such that, we move from the smaller to the bigger. So that's why you need to make sure that there's no class that is more important than the other one. Every class is important. So I wait for a trend line break here. I see trend line break, I buy, I make money. Don't worry, we're going to I'm just giving you the picture, let me say a rough picture of how it's going to be like. I buy. So during an upward trend, you buy, overbought, oversold rather. You don't sell overbought. All right. And it just goes on. Let's look for a bearish trend now. Now, this is a bearish trend. Price trending bearishly. And what I'm going to do is to wait for overbought. This is the first overbought that I had here. And I plot the trend line. Okay. I plot the trend line. Price broke down. It moved a little bit. Not really. It didn't really move that much, right? Didn't really move that much, but price moved. The next one was here. Then I just plot my trend line. Price broke downward. Good profit there. So, but later it turns upward. We have bullish trend, and so just so on and so forth. So go to your chart, see for yourself. So with what I've even taught you today, you have a trading, you can actually practice this on your demo. All right. That's until next week when we're now going to refine all of these things together to form a proper trading strategy that we can use to trade. Okay. So that will be the end of today's class, guys. Thank you very much. It's been a very long one. And I hope you guys really enjoy it. So if you have any question, please drop your question. From I think Achibongs wrote something, but I think it's a point to take note of in the trading. So need more emphasis. Yes, we're gonna lay more emphasis. I don't really get that question right. But I think it's a point to note to take note. I don't get that well. If you can put it better. Okay, so if you have any question, guys, please drop your question. So you can see now we started by revising the trend analysis. Okay, we started even by talking about the trading philosophy we want to adopt. Trading philosophy is the one that follows the trend. So if you want to trade along the trend, you have to understand trend analysis. We've already explained trend analysis. Okay. And we talked about the moving average, the different ways we can use the moving average, right? And we talked about the momentum indicators, the different ways we can use them, and the best way to use them, okay, in the context of the trend. So when we meet next week, we're going to refine this thing very well. And I'm going to, there's going to be a presentation, of course, about a trading strategy that adopts all of these tools. And we're now going to learn how to use the price momentum divergence, how to um, determine our entry, how to determine our exit, that's the stop loss and the target. That's what we're going to do next week. So please, you don't want to miss it. This video will be available so we can watch it again. So thank you very much, guys, for attending this class. So this is where we're going to end today's class. So let me pause the recording.